I think this is one of the more interesting times from a macro perspective, both because macro and policy is driving most asset returns significantly, and at the same time there's more uncertainty than has existed in particularly the policy environment than we've had in a long time. And so from my perspective, we're the sort of big outstanding question, I should say, absent the administration, we're basically actually in a pretty good economic environment. Growth's pretty strong. Central banks are easing. They're actually easing in global central banks have eased and are expected to continue to ease in an environment where growth is okay. And part of the reason why that is because inflation globally has receded, which has been given those central banks the ability to ease in response. And so if we didn't have an administration, a policy question in front of us, we'd be looking at a late cycle environment with a easing impulse, a global coordinated easing impulse on both the fiscal and the monetary, which would typically be good for stocks and gold. And so that's kind of like that's the baseline backdrop. Now, on that backdrop is, and I should say up until really the beginning of this year, a lot of what we saw for the previous couple years was sort of consistent with that general dynamic. Growth's pretty good. If anything, markets were too worried relative to those sets of conditions, and that continued easing was supportive to asset prices, stocks and gold, et cetera. The administration really throws a wrench into this whole thing, because what is going on is basically an exogenous set of negative growth policies that are likely being pursued by the administration. The real question is, there's a big question about the magnitude of those, but the direction is pretty clear, which is that restricting immigration is a meaningful drag on economic conditions, as much as 1% of real growth. And pursuing the tariff policy can, hard to know. And, if we recorded this tomorrow, we might have a different story in terms of exactly what the tariff policy in place is. But, we were looking at a drag on growth somewhere between sort of 0.5% in the best case scenario and almost as high as 2% in the max impact scenario. Those are pretty big drags on economic conditions. And so if they are, the immigration one almost certainly seems like it's going to happen. I mean, is happening and seems like it will persist. The tariff one is the big question, and there's a lot of ambiguity there, but sort of every day that the tariff dynamic continues to be in place, and at least right now, it looks like something like 15% tariffs are going to be in place for the period of time in which they deal with the IEPA judicial ruling, and then possibly for longer than that if the administration gets ruled against and then implements Section 122 tariffs, which allows them to have 15% tariffs for up to 150 days. So it looks like roughly that 15% level is in place right now. That is big enough to create a sufficient drag on economic conditions and investment that could start to meaningfully slow the economy and create real weakness. And that's coming at a time when asset prices, particularly stocks and equity indices, are not really pricing that in.